What other criteria you're looking at? Are you doing the whole cash flow? I mean, most of the places I'm thinking of would like to buy the building they're already occupying and paying rent on. And so there's some presumption of ability to pay there if they've been paying their rent. But you do look at credit score, their cash flow, their reserves, and their ability to put 10% down or 15 down.
Yeah. So I think if it's a
Correct.
rent replacement, that's a easy decision, right? Because you're really just taking out how much you're paying in rent versus what the loan is going to be. And if there's a difference, then you have to calculate that difference to see what the cash flow will be to pay that, right? But if, let's say, it's an existing business and they already own a real estate, then it's an expansion, right? Then I'm adding the rent for that existing building plus the rent that they're going to be paying there for that new business. But yeah, primarily, Martin, is 2-3 years of historical cash flow. I've got financials, tax returns, and I spread them the last 3 years and basically take all the net income plus depreciation plus the rent that's going away, and do they have enough cash flow to cover the pro forma debt of that SBA loan? And if they have plus in a room, every bank will have their own debt service coverage ratio, but ideally 1.2 and above, it's a good indication that that's a good owner-occupied real estate loan.
I want to ask one other question we'll get on specifically,
Yeah.
but what's the quality of financials when you say I got to look back 3 years? You're smiling. Do you routinely get financials that, holy cow, this looks great, I trust this, man, they know how to add numbers and know what coverage is? Or is that what you usually see, or do you have to do some machinations and some explanations?
Yeah, I'll tell you, and Cashin, feel free to jump in here. I'm just going to speak on what I'm in my space, right? I mean, just to give you an idea, my typical clients are anywhere from the 5 million and 40 million, even more, 75 million revenue, right? So when you're on the higher end, those are quality, typically more quality. They have a CFO in place. And the quality of the financial reporting is just higher, right? Because the sophistication of the business is more, right? But typically in the SBA space, because, and Cashin, please correct me if I'm wrong, but typically is the 2 million in EBITDA and less is typically an SBA space, okay? And that typically some companies will have a good financial reporting. They don't necessarily have to have audited financial statements, but their quality is reviewed by a third party or something like that. Or if they're a little bit smaller, they have QuickBooks and they have their company prepare financial statements, and hopefully they're keeping up that. I know this is a topic that you guys talk about with your clients a lot, so I know that I want to dive into a little bit different, but ideally I want them to keep up quarterly, right? If you can do it monthly, that's even better. But in the small business side, I'd probably say, hey, if you not can keep up with quarterly financial reporting, it's an issue, right? It's already a weakness for you, and it's gonna put you in a harder spot to have access to capital, right? So I have a lot of times, Martin, where I get the 3 years financials, and we are now in August, and then I would like to see March, right? Well, hopefully I'd like to see 630 numbers, but some companies don't have that quickly access to reports, and some of them may have to go back and, hey, can the CPA help us here and get those reports because we're applying for a loan? But that's the balance, right? Where, hey, how good are those financials? How quickly they can get to those reports, and then that's where the credit decision start taking place, right? Cashin, am I on the right track there?
Yeah, I think you did a good job. As you could tell from Gonzo's answer, it does depend, but the relationship we're building with the small business, one of the best ways you can show well to your lending institution is that you've got your stuff together, and that's going to manifest in the quality of your financials and the timeliness of it. I will say SBA does require all SBA lenders to first and foremost lend off of tax returns, and those tax returns are verified with the IRS to make sure what you're showing us is exactly what was filed with the IRS. But we always reconcile that back to either the internally prepared, the CPA reconciled, or the CPA audited financials to make sure everything makes sense.
I imagine that when that's all together, that's a significant time savings in the process of getting a loan.
Absolutely. Especially when we're going through economic times where things are changing rapidly. Right. I mean, if we could look at year-end 22 financials, that's great, and you could have a great year. But I mean, a lot's happened in the last 8 months, 6 months especially. So we're really focused on making sure 2023 has continued to show what most businesses are showing, which is a strong recovery from the pandemic. But we want to make sure 2022 wasn't just a blip and that you're able to continue those trends into 2023. And that's particularly important for contractors who are more susceptible to, large macro swings in the economy.
Right, for sure. I mean, what if you had to put a, rough estimate on the percentage of companies that are coming to you for an SBA loan that don't have the books in order, that don't have everything set up for you, and then how much time does that take you to be able to get that in order for them to get the SBA loan? Cashin, what do you think?
Yeah. Well, I would just say that it's, you got to be careful, right? You don't want to be, rude, right? We'll just take what we ask.
Sure.
We have a very succinct needs list, and we say, look, once you get me everything I need, then I'll start digging into it. But until you can satisfy that needs list, I'm going to move on to other borrowers that have everything ready. Mm. And so the clock doesn't really start until Gonzo and I feel like we have everything we need to have an internal conversation on moving forward with a credit facility for the borrower. So it's more on the borrower, right?
And I think if I can add that to Khalil, and this obviously goes beyond the financial reporting, but this is not SBA lending. This is just banking in general. But character for us in banks in general, it's a big deal, right? So when borrowers come out and say, hey, look, we had a year last year that you may see this in their financials. We still have, with looking for answers. They're kind of explaining that what happened and things like that. Everything that happened there is explained up front when they submit that package. Oh, that relationship is so much different, right? Because then it's a lot easier to go back and, I understand that they used to have a full-time controller in the office and they lost it because pandemic or something happened, and so they were having a hard time keep up with some of their financials. And just having that conversation up front with clients, it's a big deal, and then it makes the whole relationship and process smoother in that regard, for sure.
Hey, my last question regarding real estate, and then unless Khalil has some or you want to add, we'll move on to others. But does getting an SBA loan alter your existing credit facilities with other institutions? I mean, so long as you can meet the cash flow, but you don't want to say, hey, we're taking out your local bank and your operating line, and does it have an effect other than on cash flow?
You mean like if they get an SBA loan with an institution, they are limited to go out and get a loan with a different institution? And
that's one method, one way of thinking of it. But I'm also thinking I've already got a line of credit and it's drawn down, and I've got an operating loan, fixed, term operating loan. I'm cash flowing, but do you come in and want to take them out, or you're happy with that as long as the cash flow works?
That'll be case by case basis, definitely. But the first thing that comes to mind is like if it's a working capital facility. And I don't know if that's where you're going, Martin, but like typically banks want to have their operating accounts with the same institution, right? If it's real estate, then that's not always required. I mean, I think banks like when it's the whole relationship, but when I'm doing analysis, I'm including all their senior debt to get to my decision on cash flow, and then that will determine if I can do that SBA loan or not. I don't know if I answered your question there or not, but
No, you did, but you're not going to come in and say, hey, if you want to do business with us, you got to give us those 3 loans too. Not automatically.
Not
you
automatically.
wouldn't do that.
Cashin, unless you have a different view there, but that's not a per se requirement.
Yeah, Gonzo said it well. It's case by case. I mean, ideally, BOK Financial is a relationship bank. We're not transactional, so it's when we do look at lending to a new business, a new client to the bank, we will look at providing a full turnkey commercial banking relationship. It could be a la carte out the gate, where it's like, hey, I really like your proposal on your cash management and your line of credit features. But right now, I got 60 days to close on this real estate. Can we just focus in on that? And so we earn the right to win the rest of the business if we can execute effectively on the owner-occupied loan. Then we'll come back and talk about operating cash management, line of credit. But if the borrower out the gate is telling us they're unhappy with their current situation, we can move forward with multiple debt facility requests at once.